I'm going to go over a whole life insurance policy and how we showed someone how to get 3 times the amount of cash value without paying anything extra into their policy. So what we've got is a 46-year-old female. She is funding $43,000 per year, and her plan is to pay into the policy for 15 years. Now, the company she selected was Mass Mutual, and the product she chose was a 15-pay policy. Now, what we're going to look at is 2 versions of this product, and what you're going to see is it'll be the exact same product with the same out-of-pocket for her, but you'll see how we literally got 3 times the amount of cash value in the first year alone, and that gap widened over time, where you'll see an extra $100,000 to $200,000 in cash value by the time she retires. So what we'll cover is as follows. First, we'll look at 2 different ways to set this policy up. We'll examine the client's payment. You'll see that it'll be exactly the same, so she's not going to pay anything extra. And then we'll also look at the agent commission. And full transparency on this, the commission figures that you'll see are based on the rates that I'm paid. So it's exactly what our company would receive if we sold this product with this company in the 2 different ways you're about to see. Make sense? All right, cool. Let's have some fun. So the first illustration is what she has. She was actually sold this policy a couple of years ago. So it's a whole life 15-pay policy. You can see that up here. And it is with one of your largest mutual companies in the US. Now, what she's paying every year, $43,000 and change. First year cash value is this column right here, $13,000 and change. Keep that dollar figure in mind. It's a 15-pay policy, which means premiums are due for 15 years. She does not have to pay that long, but her plan is to do that. By the 15th year, what's her cash value? $794 and change. Okay. Keep that number in mind. Let's look at option 2, shall we? Here's what she could have had. Exact same company and exact same product. Mass Mutual, whole life 15-pay. The difference is we have this LISR attached. What this stands for is Life Insurance Supplement Rider. It is a rider we attach to the policy to generate more cash value, and it also makes the policy very flexible so she can adjust her payment over time. But here's what I want to hit on. Her out-of-pocket is exactly the same, $43,240 for a period of 15 years, if we look at the bottom here. No more payments after the 15th year. The first year cash value, instead of $13,000 and change, is almost $39,000. And the year 15 cash value, instead of $700,000 and change, is just over $900,000 with the exact same product and the exact same company. What's the difference? Well, if we go back to option 1, you can see the breakdown up top. She's paying $43,000. Of that $43,000, it's all going toward the premium. We've got a small amount going toward what is called a waiver of premium. That means if she's disabled, the premium is waived for her and the company pays it. But it's all going toward the premium. This is how most whole life insurance policies are sold, by the way. It's a little bit more than 90% when you look at the industry statistics. So keep that in mind, and let's look at the second example that had a lot more cash value. What do you notice here? Well, now the premium is $4,300 and change. Literally 10% of that $43,000 payment. It's $4,300. The rest is going toward term insurance, a small amount, but the majority is going toward what is called a PUA rider. Mass Mutual has different terms for this. It stands for paid up additions. It's how we maximize the cash value of a policy. So let's look at a side-by-side comparison. This will be a little bit easier to follow. So first, we'll start with option A. This is the example where all of her payment went toward the minimum premium. Nothing went toward PUAs, so the red column matches the blue column. Then you've got the total out of pocket or total outlay. This tallies up all of her annual payments. What is highlighted in yellow in the 10th year is the first year she breaks even. So what that means, just to put this into perspective, is year 10 is when her cash value finally exceeds the total amount she's paid in over 10 years. That means that she ran a loss for the first 9 years. A lot of times when I talk to folks who have looked into whole life insurance before and did not proceed, it's because of things like this, that it takes 7 to 10 years just to get their money back. A lot of times it's a business owner or real estate investor that says, why would I do this? Like, it's too much of a lost opportunity cost to run a loss that long. I want an early break-even point. I get the benefits of cash value, but I need my money up front. Otherwise, it does not make sense. So with this policy, here's what I would make. First year commission, just about $22,000. And this, by the way, is a low commission product. There are other products that would pay closer to $40,000 in the first year. And if I looked at a smaller company, it would pay me more than the full first year premium, where I'd make more than $45,000 in commission in the first year. We don't sell products like that though, and you'll see why in a moment. But with this product here, I'd make about 22 grand in the first year. I would also earn renewal commissions if she continues to pay through the 10th year. And my total 10-year commission would be $43,000 and change. Okay. Compared to option B, where I've got that premium minimized, PUA maximized, same outlay. The out-of-pocket is exactly the same for her. Look at your cash value. The break-even is year 4 instead of year 10. Now all of a sudden she looks at it and says, I can use this for other opportunities, and even if I don't use it, it's an asset on my personal balance sheet. I've got more money. Look at this. And this shows really where the money goes. So by reducing that premium, what happens to the commission? It's $3,000 total in the first year. And by the 10th year, it's $12,000 and change. What's interesting about this is the 10-year total is almost 50% of the first year commission with option A. Where'd the money go though? Into cash value. By reducing the compensation, you're always going to see this. You're going to maximize the cash value as a result. So let's look at a short-term and long-term comparison. We mentioned that she's got three times more money in the first year. Here's year 1. It's almost $26,000 more. Same out of pocket, just a different design. By the 5th year, how much more? Almost $60,000 more. By year 10, about 86. Year 15, you're almost at $110,000 more in cash value. The 15th year, almost $130,000. You see what's going on. Year 25, she's 71 years old at this point in time, almost $150,000. By year 30, it's $170,000. And if you want to look at it long term, that gap just widens. So by designing the policy differently, specifically by reducing the premium and reducing compensation, the premium generates compensation, by the way. So if you ask your agent to reduce the premium, that's going to reduce compensation. But that's how you 3x the cash value. Sometimes it's more than that, which is interesting. Depends on the company and product. So to recap, what's the difference? Well, the difference is that option 1, all of our money went toward the premium. And with option 2, we minimized the premium and maximized the PUA rider, which is how we maximize the cash value. So with all of that said, what do I do? If I'm looking at a whole life insurance policy and I see this and I know that I should have more cash value, but I don't know what questions to ask, here's what I would do. If you are speaking with a life insurance agent right now, let's pretend you and I were cousins and you're working with your best friend from school who just got in the life insurance industry. You want to put the business through them to try and help them out so they can earn a commission, but you also want to make sure you have as much money as possible. Here's some questions I would ask. Number 1, I would ask, what is my base premium? Then, number 2, I would ask, what percentage of the total payment is my base premium? Why I would ask those 2 questions is because the base premium can typically be as low as 10% of whatever my total payment is. That's the case with your 4 major mutual companies, being Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Now, sometimes when you ask for this, you might get a rebuttal like this. The policy will MEC. MEC, by the way, stands for Modified Endowment Contract. It's a taxable event with a life insurance policy. Why people are attracted to whole life insurance is because the cash value is a safe, liquid, and tax-free place to put money. So if you hear the policy will MEC, what I would do as a follow-up is ask, can I add a term insurance rider? The answer is yes. Now, if you are told yes, but then you hear, well, it gets expensive later, so we don't like to do that. Here's what I'll say. That's a sales tactic that is often used to sell higher base premium policies because the compensation is primarily driven off of the base premium. This is what happened when I worked at other agencies. It was always sell more base premium because that's what drives the compensation. It also gives agents bragging rights when they can say, look at all the premium that I wrote. It's like, well, who cares? Especially if your clients want cash value. But with that said, if they say it'll MEC or the term rider gets expensive later, what you could ask to try and get to the bottom line to make sure you have the best policy possible is I would ask to see the term rider removed after the funding period. So for example, the policies we looked at had funding for 15 years. If we pull that illustration up again, the good one, you'll see a term insurance rider is attached, and we removed it after the funding period. Now, if your agent does this in an illustration, and then the policy becomes a MEC in year 16, for example, what I would ask as a follow-up is, well, can we just partially reduce it in year 16, or just remove it a few years later and have the policy pay for it internally? The costs are not going to go up that much over a 3 to 5 year period. They're not. Not as much as they would if you just went with a higher base premium. I'll say that much. So really, the item to be aware of is to prevent a MEC, extra steps can be taken to maximize your cash value. So with all of that said, I do hope this helps. Please feel free to reach out with any questions. You can leave them in the comments below, or you can DM me. And as always, I hope this helps. Thanks so much for watching.